The U.S. debt ceiling is a limit on how much money the federal government can borrow to pay its bills. It is currently set at $31.4 trillion, but the government has already reached that limit and is using accounting tricks to avoid defaulting on its obligations. However, these tricks will run out soon, and if Congress does not raise the debt ceiling by early June, the U.S. could face a historic default that would have severe consequences for the economy and the world. A default would mean that the government would not be able to pay all of its bills on time, including interest on its debt, Social Security benefits, Medicare payments, military salaries, and more. This would damage the government's credit rating, increase its borrowing costs, and erode its credibility as a global leader. It would also create uncertainty and panic in the financial markets, which could lead to a sharp drop in stock prices, a spike in interest rates, and a flight from US-denominated assets. A default would also hurt the economy by reducing consumer confidence, business investment, and government spending. This would lower economic growth and employment, and increase poverty and inequality. A weaker economy would also reduce the demand for oil and other fuels, as people and businesses would cut back on their travel and production activities. This would lower oil prices and revenues for oil-producing countries and companies. According to some estimates, a default could reduce U.S. GDP by 6% and global GDP by 4%. It could also trigger a global recession and a financial crisis that could rival or surpass the 2008 to 2009 crisis. The effects of a default could last for years or even decades, as the U.S. and the world would struggle to recover from the shock. The U.S. has never defaulted on its debt before, but it has come close several times in recent history. The most recent debt ceiling crisis was in 2011, when Congress delayed raising the limit until the last minute, causing market turmoil and a downgrade of the U.S. credit rating by Standard & Poor's. The 2011 crisis also led to the Budget Control Act of 2011, which imposed automatic spending cuts known as sequestration that harmed economic growth and public services. The current debt ceiling crisis is largely driven by political disagreements between President Biden and Republicans in Congress over federal spending and taxation. Republicans have refused to support raising the debt ceiling unless they get spending cuts or other concessions from Democrats. Democrats have argued that raising the debt ceiling is a necessary and routine step to pay for past spending decisions that both parties agreed on, and that it should not be used as a bargaining chip or a political weapon. The only way to avoid a default is for Congress to raise the debt ceiling before it is too late. However, time is running out and there is no clear path to a compromise or a solution. The stakes are high for the U.S. and the world, as a default could trigger a chain of events that would hurt the economy and reduce fuel demand. The U.S. debt ceiling crisis is a major threat to the global economy and oil markets. If the U.S. government fails to raise its borrowing limit by June 1st, it could default on its debt and trigger a financial meltdown. This would have serious consequences for oil prices and demand. One of the main effects of the debt ceiling crisis is higher interest rates. The cost of borrowing money would increase for the U.S. government, businesses, and consumers. This would reduce spending and investment, and slow down economic growth. A weaker economy would mean less demand for oil and other commodities. Another effect of the debt ceiling crisis is tighter lending conditions. Banks and financial institutions would face more risk and uncertainty, and become more cautious about lending money. This would make it harder for businesses and consumers to access credit, especially in emerging markets that rely on dollar funding. Less credit would also mean less demand for oil and other commodities. These two effects would combine to drag down oil prices and dampen oil consumption growth. According to Bank of America, Brent crude prices could fall to $80 a barrel in 2023, down from $88 previously forecasted. The bank also lowered its global oil demand growth projections to 1.2 million barrels per day in 2023 and 1 million barrels per day in the U.S. Debt ceiling crisis is not the only factor affecting oil prices and demand. Other factors include the COVID-19 pandemic, OPEC+ supply decisions, geopolitical tensions, and climate policies. However, the debt ceiling crisis is one of the most urgent and unpredictable risks that could derail the recovery of the oil market and the global economy.